Imagine this. You have 10 lakhs cash with you. You deposit it into your bank account thinking it's safe. But then an income tax notice arrives and the tax on the 10 lakhs is not 2 or 3 lakhs, it's whopping 8.4 lakhs. Yes, 84% tax and penalty on your money. This is not a horror story, this is the reality under the Income Tax Act's most brutal section, Section 115BBE. In today's video, let's break down this confusing rule, which cash, which deposits, and which investments trigger this massive tax trap. More importantly, I'll show you the one legal way to reduce this 84% penalty to 78%. But first, we need to know what triggers this rule. What exactly is the unexplained income the Income Tax Department is looking for? Let's dive in. Section 115BBE is triggered when the tax authorities find what is called deemed income. This is income that you cannot provide a satisfactory explanation for. It's automatically deemed to be your income and taxed punitively. The most common trigger is Section 68 unexplained cash credits. This is when you make a large unexplained deposit into your bank account. If you can't prove the source, say a documented loan, a gift, or previous savings, the IT department calls it black money. This usually applies to businesses maintaining books of account. Next, we have Section 69, unexplained investments. Think about buying shares, a flat, or even a fancy car, and the purchase price doesn't match your declared income. And sections 69A and 69B cover unexplained assets. That gold, jewelry, or hidden cash found during search, commonly known as raid, in your home or locker that wasn't recorded in your books. Finally, Section 69C, unexplained expenditure. If you spend a fortune on a foreign trip or a destination wedding, but your income is low, the expenditure itself becomes the unexplained income that is taxed. It's crucial to understand that Section 115BBE primarily targets unexplained Indian income and assets. Undisclosed foreign income and assets are usually covered under the separate and equally stringent Black Money Act, legally known as Undisclosed Foreign Income and Assets and Imposition of Tax Act 2015, where the penalty is much higher. Now that you know what IT officers are looking for, let's break down the math that leads to the 84% tax bill. The core of Section 115BBE is a flat tax rate of 60% on gross undisclosed income that you earn in India. You get zero benefit of the basic exemption limit and you can claim zero deductions. Let's take an example. If the IT department finds, say, 10 lakhs, the base tax is 60% of 10 lakhs, 6 lakhs. To this, we have to add 25% surcharge, which is 1.5 lakh, plus 4% health and education cess, which is 30K. This brings your final minimum tax liability to 7.8 lakh. That is a straight 78% effective tax rate. But where does the 84% figure come from? It comes from the penalty under a separate section 271AAC. If the income tax officer determines the income was not disclosed by you in your ITR, they can levy an additional 10% penalty on the tax payable, that is 10% of 60% tax. That pushes your total to 84%. Now the crucial part. How can you bring this 84% penalty to 78%? The key is voluntary disclosure. If you proactively include the unexplained income in your ITR and pay 78% tax before the income tax department finds it out, you pay no penalty. This means you still pay the high mandatory 78% tax, but you successfully dodge the extra 10% penalty. Is there any way you can avoid this trap, or should we call this as a tax planning strategy? The only defense is documentation. because the burden of proof is on you, the taxpayer. Step 1. Keep a money trail for everything. For large cash deposits, you must have proof of the source. For gifts received from specified relatives, gift deed, and so on. Step 2. Ensure asset to income consistency. Make sure your assets like house, car, etc. match with the income that you declare in your ITR. Step 3. Check your AIS and 26AS. The IT department already knows about your high value transactions. Deposits over 10 lakhs, property purchases, and large investments already appear in your AIS. Make sure you disclose all this in your ITR. Step 4. Damage control via voluntary disclosure. If you find unexplained income before the IT department does, voluntarily declare it in your ITR by revising or updating your return. You pay the steep 78% tax, but you prevent the 10% penalty and avoid the risk of prosecution. So, to wrap up, Section 115BBE is a clear message under the Income Tax Act. Unexplained income that you earn in India will be taxed at a minimum of 78% and a maximum of 84%. The only difference is maintaining a clear, documented, and satisfactory explanation. That's it in today's video. Hope it was informative. Thank you for watching.